Hello everyone, welcome to the Analyst Classroom. Today we are going to learn about the income tax in context of the CFA Level 1. So in the CFA Level 1, basically there is the only two main concept we need to dig deeper and understand, and that's it. That is a deferred tax liability and the deferred tax asset. So let's understand what is the deferred tax liability. So we need to understand the deferred tax liability. We understand uh, first example of any rent expense. So suppose I have a rent expense of 500 and I paid rent of 400. So what would be the balance impact in my balance sheet? So I will show the liability of outstanding rent of 100 because I paid less and I showed more in the my income statement, as income statement always prepared on the accrued basis. My expense is 500 but I only paid in cash of 400 rent. So differentiate will be my future liability to be paid. Okay, in the similar way, if i I shown the tax as expense 500 and tax paid only 400, and tax paid is also called as tax payable in the other books we will discuss. So if I have a tax expense of 500 but I paid only 400, so that is called the difference is called as deferred tax liability of 100. And in the similar way, if I have expense of rent 500 but I paid 600, I paid extra, so my different will be my asset as a prepaid rent 100. And in the similar way, my tax expense will be, if my tax expense is 500 and I have paid the 600 of tax, then the different will be called as the deferred tax asset. So basically, why we have tax paid and tax expense different when the income statement is the same? So let's understand that every organizations prepare two books of account. One is the accounts book and other is the tax book. But why companies prepare two books of account? Because the accounting rule, IFRS and US GAAP, can be different from the taxation law. So as per the accounting rule, your accounting tax payable could be different than the taxation law, but governments ensure to collect and calculate your tax as per the taxation law. So companies need to prepare two books of account for the accounting purposes and for the tax filing purposes. So why the taxation law and accounting rules are the different? Because their objectives are the difference. uh, Accounting objectives to show true and fair value of the business, and the tax laws objective is to collect the higher tax revenue, collect it faster, and other social objectives. So this is the accounting book and this is the tax book. So there could be the difference between the cost of sale and net sale also, and that could be result into the PBT of the accounting books and the taxation book. So PBT of the accounting might be XYZ, so my tax will be the X in the accounting book, and ABC in the taxation book. So A will be my tax in the taxation book. So income tax expense is 500 and in tax payable in 400 in the tax book. So scenario 1, my accounting book tax expense is 500 and as per my textbook my tax payable is 400. So I will pay as per my textbook, not as per my accounts book. So I paid less or more? I paid less. So if I paid less, I need to create a liability called deferred tax liability. In the second scenario, if my income tax expense is 500 and my payable is 600, so I will create a asset as a deferred tax asset because I paid more. Let's understand with the other example. For example, I purchase a machinery of 100 and the depreciation as per account book is 40%, 30%, 20% and 10% of the cost. And tax law says 20% flat for per annum. And we assume that the revenue of the company is 100 each for 5 years and tax rate it is 40%. So depreciation could be one of the reason to for creation of the DTA and DTL. So this is the accounts book, this is the accounts book, and this is the textbook. So year 1 2 3 4 5, and in the first year I have sale of 100, depreciation is 40% as per the account book, 60 is my PBT, and the tax expense is 24 as per account book. In the first year I have 100 rupees of sale, 20 is the depreciation flat, PBT will be 80, and as per the 40% my tax expense is 32. As per the taxation book, 32 is my tax payable. Uh, means I paid 32, but in the accounting book, 24 rupees is shown as the tax expense. So difference 32 minus 24, 8 will be my deferred tax asset. I show as the deferred asset due to I have paid more than I actually shown in my accounting books. In the next year, 30 is the depreciation, 70 is PBT, 28 is my tax expense. Here 20 depreciation, 80 PBT and 32 is tax expense. 32 minus 28, I have paid 4 extra in textbook. So I that will be added in the carry forwarding asset. So 8 plus 4, I will have a 12 of deferred tax asset. In the next year, 80 is my PBT after the 20 rupees of depreciation, 32 is tax expense, and in the textbooks also 32 is my expense. So there will be no addition or reversal of the DTA. In the next year, 10 is my depreciation, 90 is PBT, 36 is my tax payable as the tax expense as per the accounts book. And in the textbook, 20 is depreciation, 32 is my tax expense. So in this example, I have shown the tax expense of 36, but I have only paid 32 rupees. So I paid less, but I shown extra. So that will be my deferred tax liability. And if I have deferred tax asset, then there would be the reversal of the deferred tax asset. So I have 12, and I will reduce the deferred tax asset by 4 because I paid 4 less. In the last fifth year, my depreciation is 0 in the accounts book, my PBT is 100 and tax expense is 40% as per the 40% tax rate. And in the textbook, my 80 is PBT and 32 is tax expense. So I have paid 8 less but I shown the 8 more in the tax expense. So 8 will be the reversal of the DTA. So my in the fifth year my DTA will be the 0, and my tax expenses will be the 160 for the accounts book also, and 160 for the textbooks also. So all the figures will be matching in the last year of the depreciation amortization schedules. So this could be the reason for the creation of the deferred tax asset and the deferred tax liability. And this is the temporary difference or the permanent. It's a temporary difference for the asset life as for the only asset life of the business. So this is the timing and temporary difference, because the depreciation timing is difference in the both book, and it is the temporary. uh, that's why timing and temporary difference is the reason for creation of the DTA and DTL. And the next is the formula to calculate the tax expense. So the formula to calculate the tax expense for the income statement expense. So income tax expense is equal to tax payable as per the textbooks, plus if the deferred tax liability increases, add deferred tax asset, reduce, add subtract deferred tax asset going up, and subtract deferred tax liability goes down. So if liability goes up, add liability goes down, subtract asset goes down, add asset goes up, subtract. So in the short, deferred tax liability has the direct impact. Liability goes up, add liability goes down, subtract. Asset has the indirect impact. Go asset goes down, add, and asset goes up, subtract. Reverse, liability direct, asset indirect. Okay, how can we come to the income tax expense with this just a formula without doing this much of work? Okay, so let's take the older example. Calculate the tax expense with the formula from the earlier example. For example, I have given the 5 years 5 tax payable as per the textbooks, and deferred tax asset. Changing delta is changing the deferred tax asset. So in the first year I have given the 32 as a tax payable and 8 is my deferred tax asset. So what would be my income tax expense as per the accounts book? So as per the above formula, if my deferred tax asset is increasing, I will reduce. So 32 minus 8, 34. 32 minus 4, 28. 32 minus 0, 32. 32 plus decrease means add, reverse impact. 32 plus 34, 36, and 32 minus 32 plus 8, 40. Say this way, by this formula you could calculate the income tax expense if you have given the tax payable and the deferred tax asset or liability. So the next concept is carrying value versus the tax base, CV versus the tax base, TB. The carrying value means a value of an asset or liability as per the books of the account, and the tax base, TB, is the value of an asset or liability as per the textbook. Value as per the textbook, value as per the accounts book. Next is the deferred tax asset or deferred tax liability, can be calculated by the difference between the carrying value and tax base multiplied by the tax rate. So think mm, and you need to uh, identify uh, if the if the result of this formula will give you the deferred tax liability or the deferred tax asset, we need to understand this flowchart. For example, if the tax base is lower than the CV, tax base is the lower than the carrying value, then my textbook depreciation will be the higher because my tax base is lower, so depreciation would be the higher. If the depreciation is the higher, my profit of for the textbook will be the lower, and my tax expense tax paid will be also the lower. So this will be my less so liability. So my deferred tax liability, that will give me the deferred tax liability if my TB is lower than the CV, and if the tax base is higher than the CV, that means my textbook depreciation will be the lower. That's why my TB is higher, and that will result into the higher profit for due to the lower depreciation and higher profit, so higher tax paid. So higher tax paid will create the deferred tax asset. So you need to think logically to understand, it will give me the deferred tax liability or the deferred tax asset. Let's understand with the example of the older 100 rupees machinery example. So in the first year, my carrying value cost minus accumulated depreciation. First year is my 40%, so 100 minus 40, 60 is my carrying value, and tax base value is my 100 minus 20. Tax bills none other than the carrying value of the tax book, carrying value of an asset for the tax book. So 80 is my first year carrying value, 60 is my carrying value of the accounts book. Or you will calculate this side or this side, any of the side you you like. So 80 minus 60, 20 is 20 is the difference. So 20 multiplied by 40%, 8 is my DTA. As we understand here that if the tax base is higher, my it will create the DTA in the next year. 30 is the carrying value of the as of the account book, 60 for the tax. 60 minus 30, 30. So 30 multiplied by 40%, 12 is my DTA. 60 60 minus 30, 30. 30 is the difference, 30 into 40%, 12. And here also 40 minus 10, 30 is the difference, 30 into 40% is also the 12. Okay, then the difference is 20 minus 0, 20 is the difference, and 20 into 30%, 8. So here, so this will give you the deferred tax asset as my tax base is higher than the CV, and you will get directly multiplying directly get the DTA by multiplying the difference between the CV and the TB. So let's move to the another topic that explains that unless and otherwise mentioned, provision related liability will always have a tax base of 0. It means you can't show provision related liabilities in the tax book. Okay, let's understand with the example. For example, accounting book shows the sales of 100 and provisional liability of 5 rupees. It means i it means i have a future liability of paying warranty of rupees 5. I have accrued, this is the provision, I have accrued the warranty, so I will need to pay in the future for the warranty rupees 5. Okay, that provisional liability is allowed in the accounts book, so my PBT will be the 95. My balance sheet will be like this, retained earning is 95, cash is 100, and provision liability is 5. When I will try to show the provisional liability in the textbook, sales is 100, provisional liability is 4, my PBT is 95. The government will come and say that Nana, you can't show the provisional liability of rupees 5 as you have not paid your liability in this year. So you need to pay on the you need you can't deduct which you have not paid. Okay, when you pay your life warranty, then that year you will show. So in the textbook I need to show the 100 rupees only. I can't show the provisional liability in the textbooks. So my retained earnings will be the 100 and cash will be the 100. That will create the temporary difference. When I pay the provisional liability, this will reverse my DTA. Okay, so this also could be the reason for the creation of the DTA or DTL. My accounting book profit is 95, tax book profit is 100. I pay more, so it will create the DTA. Okay, the next reading is the what happened to your DTA or DTL when tax rate hikes or reduces. So the understanding is if the tax rate goes up, DTA and DTL will goes up proportionally, and if the tax rate goes down, DTA and DTL will go down proportionally to the tax rate. Let's understand with the example. The old depreciation example, at the end of the year 3, my carrying value is for the tax accounts book is 10 and tax base is 40. Difference is 30. So 30 into the tax rate, I will get the DTA. So 12 is my DTA at the year 3. Okay, now suppose at the end of the year 3, government announces that starting from year 4 from year 4, taxes will be increased to 50%. Till year 3, taxes is 40%. From the year 4, taxes will be the 50%. So would you adjust your DTA or DTL in the current year or the next year? So the answer is, even though the tax rate hike is from the year 4, DTA or DTL adjustment should happen immediately after the announcement. Okay, you need to adjust just after the announcement in the current year. So let's understand how. My tax rate is 40%, DT is 12 in the year 4, 50% is tax rate. So what would be the DTA? So 12 into 50% divided by 40. 15 will be my DTA for the tax rate of 50. So 12 for the 40%, 50 will be the 50%. Why? Let's understand why we need to adjust the DTA or DTL. So let's understand. DTA means I have paid I have paid extra of rupees 12. Okay, but on what income? So in 12 to divide by 40%, so 30 rupees I have paid, I have shown extra, and I have paid 12 rupees on that 30 extra shown. So I will if at the 12 for the 40% on that 30. So on if my tax rate is increased, so 30 into 50%, I will have the 15 as my new deferred tax asset, as my this as my tax rate is increased. Okay, so when the tax rate changes 30 into 50%, I will have the 50 as a DTA. So lower tax of, I need to pay the lower tax of 12, or no tax on income of the 30. I have shown the 30 extra in the textbook and paid more tax on that in the earlier years. So I will not paid on that 30 rupees. So that 30 rupees multiplied by 50%, I will have now 15 rupees of DTA. So in the next, let's calculate how much we need to show as a tax expense if my tax rate is increased. So for the year 3, no tax scenario, my income tax expense is 30, tax income tax is equal to tax payable 32, increase in DTA. So there is no increase in the hmm, earlier example if tax rate is not hiked. So 32 will be my tax expense similar to the tax payable. But if tax rate is hiked 40% to 50%, I need to increase my DTA from 12 to 15. So 3 is my increase in DTA. So if increase, my tax payable will reduce. 32 minus 3, 29% will be my tax expense. So in the year 3, account book PBT is 80, tax is 29, 51 will be my net profit. So effective tax rate, if we calculate 29 divided by 80 is equal to 36.25% for the year 3. But my statutory tax is 40%. So it will reduce my tax payable. So let's discuss the next reading. If difference is permanent, then we do not create DTA or DTL. Why? Because that can't be reversible. Okay, let's understand with the example. For example, accounts book. So there is a guy who are handling the accounts book. So he has the he or she has the sales of 100, and uh, they need to pay corruption to get that work done. So that is their expense. You can't show directly corruption expense, but in some sort of good language, he shows the corruption expense 40. PBT is 60, tax is 40, and 20 will be my net profit. When the tax guy will go to show as a corruption expense, the tax authority says no, you can't show the illegal expense in the textbook. So any expense that is illegal is disallowed in the textbook. So that his PBT will be 100, tax will be the 40% his as per the tax rate, and 60 will be his net profit. So in the textbook, illegal expense or fine paid to the government is not the illegal, but you can't show in the textbook. So illegal expenses, fine to paid to the government, etc., is never allowed to show as an expense in the textbook, and these expense will create the permanent difference. So permanent difference will not create DTA or DTL. So in this example, my 40 is I tax paid in as per the textbook. So I need to show 40 as directly without calculating 40% on this profit before tax as per the textbook, because I can't create DTL or DTA if this if that difference is due to the not allowed expense in the textbook. So income tax expense is equal to income tax payable plus plus minus minus this, but this is always zero, you can't create. So 40 will be my income tax expense also. So effective tax rate will be the 40 divided by 60, 66.67% will be my effective tax rate for the accounting book, while my statutory tax rate is only 40%. Okay, now let's discuss the another reading. Let's understand first with the simpler example. For example, this is the balance sheet of the company. Equity is 500, bank loan is 300, and asset is 800. What if my bank loan is waived off? Okay, bank has waived off your bank loan. So my balance sheet will be the shown as the profit from the bank loan waiver 300, and this will be my net profit. It will mm, come this as a retained earning, and I have shown the bank loan as a zero as a waived. So this uh, my this will impact my amount of 300 move from the debt to equity. So in the similar way, if I have a DTL, this is also bank loan is also a liability and DTL is also a liability. So for some series, for the same reason, if my DTL is waived off means non-reversible. If I think that my DTL will not reverse in the future and amount uh, is is not payable, so this amount is also to be moved to equity. Okay, so bank this DTL will be shown as 0 and retained earning will be shown as 30 in the same case as this. So for analytical purpose, if DTL is expected to reverse, it is a debt. We have to pay. Or DTL is not expected to reverse, it will it will move to equity. And DTL will not reverse for the high growth companies due to the expanding capex. They always expand and always create the DTL until their growth cycle slows down or to come to the neutral. Okay, now another example. For example, this is the balance sheet, and here equity is 500, AR is 1000, my debt is 500. What if you have a doubt on receiving the 200 from your AR? You think that 200 from this AR I will not get. So you create a provision for the doubtful debt. So in the income statement, you show as a loss of doubtful debt provision, and loss will be the reduce my equity, come as the retained earning, and AR minus less provision for the doubtful debt. So my it will reduce my equity. In the similar way, if my asset, you think that you think DTA instead of AR, you think that the DTA worth of 200 will not reverse, then we will show this reversal as the valuation allowance expense. Fancy name, valuation allowance expense minus 200. You will reduce the equity, and DTA minus valuation allowance, you will reduce the DTA. So provision for the doubtful debt plus valuation allowance are the contra accounts or contra asset, called it contra asset. The account that reduces the value of your asset are shown as the contra account or the contra asset. Now discuss about the tax laws carry forward will create the creation of the DTA. Tax laws carry forward. For example, I have a loss of loss of 100. I could set off that loss in the future period when I become the profitable, so I will get the benefit of setting of that profit, uh, this loss from the future profit, and pay less tax. So this would be my this would be my benefit. So I will create the DTA. So due to you could carry forward your loss typically for 8 years in the India, companies could set off their PBT from the earlier loss and pay less tax in the future. This benefit shown as the DTA. And if the company not become the profitable until the limit provided by the government, then the DTA will become non-reversible and they need to set off. They need to do a valuation allowance expense. Okay. So this could be the reason, also the reason for the creation of the DTA. And the last reading is companies need to provide a reconciliation statement of the effective tax rate versus the statutory tax rate reconciliation statement in the financial reports. That's it. This is the core understanding of the income taxes as per the CFA level 1. Thank you for the listening. Have a good day.